Today's episode of Hidden Forces is made possible by listeners like you. For more information about this week's episode or for easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you listen to the show on your Apple Podcast app, remember, you can give us a review. Each review helps more people find the show and join our amazing community. And with that, please enjoy this week's episode. What's up, everybody? My guests on this episode of Hidden Forces are Michael Anderson and Vance Spencer. Mike and Vance are the founders of Framework Ventures, a thesis-driven venture capital firm whose team of technologists, researchers, and investors partner with founders and teams to build token-based networks and develop the requisite cryptoeconomics, governance, and community to scale. The team's focus is on the hot new space of decentralized finance, known as DeFi for short, and are the largest owners of the decentralized Oracle provider Chainlink and derivatives platform Synthetix outside of the core team and exchanges. Hidden Forces listeners have been begging me to cover this space, and I'm very happy that I finally got around to it. My choice to bring on Framework is because when I'm new to an industry, I find that speaking with investors who are focused on that space is usually the best way for me and by extension for all of you to get a sense of the ecosystem, what's important, who the players are, and what to focus on. Likewise, the rundown to this week's episode is especially helpful to anyone new to the space. But honestly, even if you think you know this sector, the rundown will probably help you. It's over 20 pages long, and I really focus heavily on two networks in particular, Chainlink and Synthetix, which are the two platforms that we spend the most time covering today. We also discuss cryptoeconomics and valuation models and how they've undergone a process of creative destruction since the 2017 ICO boom, where you might recall formulas like MV equals PQ were pretty popular, and where people tended to think of these protocols in terms of utility value versus store value. I learned a ton, both preparing for this conversation, but also in talking with Michael and Vance, who are both very smart and passionate guys, and who I think have a very clear and well-thought-out perspective on DeFi and the opportunity it presents to investors, but also to users of many of the applications that we discuss today. As a reminder, Hidden Forces is listener-supported. We don't accept commercial sponsors, and I don't interrupt the podcast with advertisements or product pitches. The entire show is funded from top to bottom by listeners like you. If you're interested in supporting the program, which also gives you access to the episode overtimes, including the rest of my conversation with Mike and Vance, the transcripts and show rundowns, head over to patreon.com/hiddenforces and subscribe to one of our 4 content tiers. If you haven't subscribed to our mailing list yet, you can do that through our website at hiddenforces.io. And don't forget to rate the show and write us a review on Apple Podcasts and anywhere else you listen to the show. Since this episode deals with investing, it's important to make absolutely clear that nothing I say on this podcast can or should be viewed as financial advice. All opinions expressed by me and my guests are solely our own opinions. And as is the case with all of my episodes, these conversations are for informational purposes only and should not be relied upon as the basis for financial decisions. And with that, please enjoy this week's episode with my guests, Michael Anderson and Vance Spencer. Michael Anderson and Vance Spencer, welcome to Hidden Forces.
Thank you for having us.
Yeah, good to be here.
It's great having you guys on. How are you doing?
Doing well.
Doing great. DeFi is going pretty crazy, but we're definitely managing it.
So, you guys know this because I tweeted it out, but the rundown for this week's episode became a monster rundown because I ended up having more time to research DeFi than I intended because we're We're supposed to record this initially last week, so I spent today, since I already had a rundown completed, I spent today looking at Synthetix, which is basically derivatives on DeFi and how they work and stuff like that. So we're going to get into all this stuff. It's super interesting. I'm glad I finally got a chance to do it and sit down with you guys. But before we get into it, especially since you're both actually in the same room using the same microphone, and I want listeners to know who is who, it's a good opportunity for each of you to give our listeners a sense of your background, like, where you've come from, where you worked before you got into this space, and like how your individual experiences are relevant to starting a crypto fund.
Definitely. I'll kick things off. This is Michael Anderson for the listeners. I started my career working in technology. I was a product manager at Dropbox and then Snapchat. At both places, I was working on commerce and payments. So we can get into it, but definitely fintech, financial technology has been a common thread throughout my career. In 2018, Vance and I were living together and decided that it'd be a good time to throw our hat in the entrepreneurial ring. We started a company called Hashleets, which was a digital collectibles company. It was built on top of Ethereum, and it was digital collectibles that were licensed by the NFL. It was a great experience. We learned a ton. And from that experience and our investing track record as angels, we started Framework.
And this is Vance Spencer for all those listening at home. Similar kind of consumer technology background as Michael. I came out of school as a management consultant and then worked in corp dev for Netflix, first in Los Angeles, more on the content side, and then in Tokyo, helping lead kind of expansion into Asia for Netflix. Michael kind of covered the Hashleets part of our background. We sold that company about a year and a half after starting it. And from that, we raised this fund, Framework, which is a venture capital fund focused on fintech with the idea that, the consumer applications of tomorrow that are financial in nature will be powered by crypto. And, to date, we've been pretty much the biggest fund investing in just specifically DeFi. And just glad to be here and saw Demetri's effectively a book of memes and notes about the space, and excited to see kind of what type of rat hole he got into.
Yeah, yay memes.
Yay
memes.
Memes
today. So what are there? That was something else I wanted to ask you guys, which is, are there other funds in the space that focus exclusively on decentralized finance? And I think you kind of answered that. The answer is yes. But how many are there? Like, is it a common thing?
Well, one thing that I think we are strong proponents of, and I think that most in the space are starting to recognize this as well, basically blockchain is eating finance. And the same way that software is eating the world, our perspective is that blockchain is eating finance. And with that, any venture fund that's investing truly in blockchain technology is starting to gravitate towards a DeFi thesis as well. I'd say that we were one of the first to promote this and promote this as our core focus, but there are probably a handful of others that in the last 3 to 6 months have come on board and started to promote themselves as a DeFi fund as well.
In the background of DeFi basically growing up and finding product market fit was, the 2017 ICO bubble, VCs, huge funds throwing, tens, if not hundreds of millions of dollars at things like Telegram and smart contract platforms that are competing with ETH. And, the industry is largely getting over this hangover from this huge party that it had in 2017 and 2018 that, it funded a lot of really interesting experiments, but, not a whole lot of focus was put on the application layer or really anything that consumers could interact with. And so, we were the first in this category just because it was so nascent. We had this specific focus, and we are seeing the industry start to pivot and kind of copy what we've been doing. And it's funny to show up to conferences and see funds that were describing themselves as kind of like smart contract focused funds now describe themselves as DeFi, but it's good for the space and it's good to see it growing, and it's good to see more dollars going to things that are actually productive.
So besides the focus on the application layer, and I don't know how much that differentiates you guys. Obviously, it is some source of differentiation just based on what you said, but what is it that differentiates Framework Ventures from competing funds in the space?
So one thing that I think we really have focused on from day one, and I think this stemmed from our experience as entrepreneurs in the space, but also just we came at it with a first principles perspective and have a very different fund entity, legal entity structure for how we organize and frankly, how we participate post-investment. And we've talked about this a bit in other publications, but we have Framework Ventures, which is the fund. And then we have Framework Labs, which is a new type of management company. And it's structured as a company. We have a number of engineers working on proprietary technology. We're the largest liquidity provider in most of the networks that we back. We're staking actively and one of the largest stakers in the ecosystem. And so what this allows us to do is not only have a post-investment participation where we can bootstrap growth, we can benefit the networks in a productive way, but it also leads to proprietary deal flow. And it's something that we've gotten a lot of access to just with competitive deals because we're the biggest users of the platforms before there's an investment round. So we think that this is a huge differentiator and probably our unfair advantage.
That's super interesting. I do want to talk about that. I want to discuss Framework Labs. It's an interesting model. It's one that I think the three of us discussed some other examples of this in a previous conversation. But before we do that, I want you guys to walk me through your investment thesis. But before you do that, maybe you can give me a much more clear definition of what is DeFi, what is decentralized finance?
Yeah, so there's two really interesting things about finance that when we look at this industry and if we try to assess, is this real? Is it moving? What type of potential does it have? There's basically two things. The first one is that finance is the largest market, that exists for consumer applications, for enterprise applications, for generally just any technology. And the second is that, there's been almost no innovation in finance over the past 30 or 40 years. And the reason why there has been no innovation in the past 30 or 40 years is because there's not a developer sandbox to experiment, to push stuff out, to see what works. If you want to launch a consumer app with its pizza delivering or it's, disappearing messages or it's, ephemeral messaging or whatever, you can go to the app store, you can write a simple app, you can put it on test flight and distribute it, boom, you've kind of got yourself a company. Finance, there's really no such thing. You can't just walk up to Morgan Stanley or Goldman Sachs or any prime brokerage and say, hey, I have a new idea for a financial primitive or a new financial instrument. And so DeFi for us is just this developer sandbox. And, when you look into this developer sandbox, the lingo of what crypto people use is money Legos. And what that basically means is that, you don't have to build all this stuff from scratch. People have built synthetic US dollars. They've built options protocols. They've built futures protocols. And so you can really quickly spin up a basic MVP of a new financial product as long as you've got, some type of data feed to tell us what it's worth and some type of collateral pool to back up the value. This is an explosion in terms of the amount of innovation you're able to do in the space. And really what DeFi is to us is this sandbox, this developer sandbox that people have been waiting for forever that exists permissionlessly. And what that means is that by permissionless, anybody can build on top of it. And from a regulatory perspective, it's much friendlier than if you were to just start a centralized company. And so that explosion of innovation is what makes us, confident that this is real and that we're just at the beginning of something.
When you say, though, innovation, what do you mean exactly? Because there has been tons of financial innovation in the industry in the last 30 years.
Definitely. And not to say that people in the financial industry haven't been innovating. I think the major difference is what we're talking about is an architectural reorienting of the stack of technology that anything financial is running on top of. And whether, it's Wells Fargo iOS application that I use for my personal banking needs, or it's Venmo, you're still relying on the internet protocols that existed and started in the 1970s and the 1980s. What we're talking about with blockchain is a reorienting of what that underlying technology stack is. And
systemic disruption,
creative destruction, all of these are monikers that we talk about in terms of how we think of blockchain orienting or reorienting the financial technology stack.
Okay. All right. So what is your thesis in this space? How would you articulate that?
So there's basically, and I'll start out by saying, we're a DeFi fund. We have a very long-term thesis. In 15 to 20 to 25 years, we can see a lot of things being operated on blockchains, whether that's, a decentralized form of Twitter or decentralized form of Facebook, where all the algorithms you can see, they're recommending content are open source and things are much more audible and transparent. That's where we see the future going. In DeFi today and where things stand, we kind of divide the world up into two different kind of theses, and their financial innovation and their financial inclusion. Financial innovation is, moving financial incentives closer to Web 2 companies as people understand them today. So, being able to hook up a Spotify playlist to a collateral feed and being able to bet on how many likes or shares or comments it'll get. And just generally, you can see this happening in Reddit with people starting to incentivize communities with their own native token, which allow them to vote and decide things for how the communities are run. So that's kind of the financial innovation side. And we see that, eventually pushing closer and closer to Web 2 as they kind of exist today and putting financial incentives directly into the kind of user experience. Right now you have advertising, you have subscription, you have microtransactions, but really the fourth business model that these things stand to create is this, token native economy where people can transact and earn, token value through interacting with protocols and doing different behaviors that the protocols themselves try to incentivize. So that's kind of the first one. The second one is financial inclusion. And, this goes from, there's, 2.5 billion people that are unbanked. That's obviously like a big stat that a lot of people like to quote with Bitcoin. But, a lot of the financial markets of the world today are geofenced. If you're a Canadian citizen, if you are in China, you can't get the same access to the US stock market, to commodities, to financial products, to financial instruments that you can if you were living in the US. And so, the opening up of those markets through just this global, transparent financial standard that's built on a blockchain is the other kind of big thesis we have. And I think we like to be kind of opinionated on some things that are kind of in the day-to-day, but relatively unopinionated on, where this lands eventually. And, as we kind of said before, this developer sandbox, when things get 100 times easier, 100 times cheaper, innovation just naturally explodes. And so while those are kind of the two theses that we have right now, it's a pretty wide berth for where things could go, but it's very exciting at the same time.
So one of the thoughts that I came to my mind is how much of the innovation that's happening in this space is because it's unregulated or largely unregulated relative to the legacy financial space. Or maybe I'm mistaken to think about that, but that came up when you mentioned creating financial products that would allow you to basically speculate on how many likes you get. I think a lot of people will wonder, what's the value of that? What's the point of that? Or maybe there really doesn't have to be a point. Your point is simply that it is. It just is. It's something that people will do one way or the other, and you want to be in the space to capture the value. But and by the way, feel free to respond to those 2 points, but I also want to drill in deeper on this point about financial innovation and financial inclusion, because I am interested in how token economies can capture value and create economic efficiencies that would otherwise be either impossible or much more difficult to achieve in a more centralized system or sort of a classical financial market. And then we can, I think, discuss financial inclusion and talk about that. But feel free to either one of you take those questions.
Yeah, these are both great questions and stuff that we talk about constantly and consistently. I think to address the first point on regulatory situations, one thing that has become clear is that there is a difference between certain jurisdictions and how they regulate this industry. But what's also clear is that there's a reason for the US having the greatest capital markets in the entire world. And a lot of that stems from trust and oversight in the regulators for the financial markets. And so this is all to say, we view DeFi as an opportunity to enhance that as opposed to usurp that. And what we think with the purpose of regulators and the purpose of regulation in financial markets, ultimately it stems from the idea that you want things to have trust and to be fair and open with the ways that people use it. And that is the ethos of DeFi. What it does is it instead moves that barrier of trust from a regulator allowing that securities exchange or that trading entity to operate within the financial markets. It moves that from the regulator to code. It moves to smart contracts. And when there are specific pieces of code that control these and dictate the parameters and dictate the rules, all of it is open, all of it is fair, and it's auditable. And so we view DeFi, maybe in comparison to centralized finance operating within the crypto ecosystem, as a more fair and transparent way of making the same issues clear and open and fair for everybody else. And so we really actually view that DeFi will ultimately be on the right side of history. And it's clear that people like Hester Pierce at the SEC are thinking about it in the same way, which is why she has proposed a 3-year grace period for token projects. And I think to Vance's point, one of the things to address the second question one of the things that we really ultimately get excited about when it comes to tokens and when it comes to decentralized finance is that in 2019, we have established 2 new token models that relate value back to the token holder. And the first one, which was popularized by Maker, is a buy and burn, where the earnings or the revenues of the network are actually flowed back to Maker holders by the protocol buying more Maker tokens and then burning them, so increasing the ownership for existing Maker holders. And the other one, which is popularized by Synthetix, is this concept of a dividend that's issued to active participants in the network, where the revenue is actually flowing to active participants. And in terms of both of those, these are very easy to understand concepts that people in traditional finance can understand, because you can do a DCF to evaluate what the value of these tokens are based on their earnings. And this really, I think, ultimately shows that these valuation models can exist in the token ecosystem where there's value. And those are some of the things that we evaluate when we're looking at new investments.
So is the dividend what people are talking about when they talk about yield farming in DeFi?
So the dividend is not specifically what they're talking about, but it is kind of under the umbrella of the larger concept of yield farming. Yield farming in DeFi refers to, you're effectively putting capital to work in a protocol in its very early stages. And the protocol is offering a disproportionately high share of tokens at the beginning to incentivize user behavior so that it can help to build a moat, bootstrap network effects, and really start to incentivize and build the muscle memory for participators in that protocol.
So when I stake my SNX and I get additional SNX through inflation, as well as SNX as a result of the transactions that are happening on the network, are both of those considered a dividend?
Those are both considered a dividend. I mean, those are kind of the concept of yield farming, I think, is the real kind of deep in the weeds crypto heads would define it. You are staking your SNX, you're minting debt, and then you're taking that SUSD denominated debt, putting it into another protocol, generating more yield, and then maybe going 2 or 3 steps forwards. And totally acknowledge that this seems a little bit absurd, but I think, this concept of community ownership and, retail being able to put capital to work to bootstrap, venture capital style return projects is very powerful in a world where, and my heart goes out to all the, the 20-year-olds who have just graduated college and they're looking for a job, and, they're in a culture of Wall Street bets and Dave Portnoy pulling out, letters out of a Scrabble bag to buy stocks. Like, in kind of downturns, if you look at history, speculation and entertainment kind of tend to converge as a form that you can generate income. And so, this is all, and DeFi's emergence is kind of all against the background of these really weird set of macroeconomic events, but it's this almost perfect proving ground for, anybody in the world with any amount of money can go buy SNX, they can stake it, they can earn a reliable dividend, and they can live off that. And basically what you're doing is you're a service provider to anybody who wants to trade against that collateral pool. And previously, that was really only open to market makers trading at large centralized exchanges. And that was kind of the only game in town for them. And this, and I hate saying this stuff, but, democratizing X, like this is an example of that. And so that's why kind of we're so bullish on this opportunity. And, the memes and all the good stuff that comes with it is just kind of a natural byproduct of it.
Okay, so we'll get into it. We'll put a pin in SNX because I don't want to intimidate people that are coming into this and need kind of an explainer, because I would like us to get into that. We might get into that in the overtime. Let's go back a second, because I want you guys to give me some examples, because I think a sort of market maker functionality and a derivatives marketplace may be a good example, and we'll get into that with SNX. But give me some other examples of token-based business models or cryptocurrency-enabled business models that have a competitive advantage over traditional business models. Like, what would be examples of that?
Yeah, one of the ones that we're really excited about is decentralized borrow-lend markets. The 2 predominant players here, Compound and Aave. And full disclosure, we just announced an investment round in Aave. But we are really excited because what this allows is natural forming capital through the use of supplying one asset to borrow another, creates markets where the cost of borrow and the cost and the ability to lend enables a lower APR than you would find in most other markets. For instance, the ability to put any sort of asset into a collateral pool like Aave and then pull out dollars, the interest on that loan is an order of magnitude less than you would find even if you were getting a personal loan from a bank.
Why is that though? Or how does that relate to the fact that these are tokenized economies?
Because they're all controlled through smart contracts, and the creation, delegation, and servicing of that borrow is done through software. There's no need for the middleman. There's no need for a bank. There's no need for operations or people to be involved. It's all controlled through code. And through this control via code, the total end-to-end flow can be optimized to reduce that intermediate fee or rent or whatever is being charged within traditional finance. And this is going back to exactly what Vance was talking about with the sandbox for developers. Before 2014, there was no feasibility of smart contracts in the form of Ethereum now. And since 2014, with the launch of Ethereum, any developer in the world can write essentially a bank account in about 25 lines of code. And this bank account does all of the primary functions that you would find at Wells Fargo or Chase Bank, but now it's owned and operated by you, and it's on the blockchain and fully able to be used by anyone.
So I haven't looked into Compound or Aave. Which one was that you were talking about? And are they both, what are they, lending? They're like banks? Like decentralized banks?
They are both borrow and lend decentralized money markets. And they're both the same general flavor of this money markets concept. They have different strategies and different tactics about how they go about approaching the market and approaching growth. But yes, they're both decentralized money markets.
How is cost of capital determined? The cost to borrow, for example.
Yeah, so this gets back to your original point about why does the token matter? There's two reasons. One, when you are borrowing in Compound or Aave, you are effectively subsidized with the native token, and that lowers your borrowing cost. What that helps to do at the beginning of a protocol's lifecycle is it helps to bootstrap the network effects of that protocol. And so, you're seeing Compound, which has been around, really in earnest for about a year and a half. It's used its tokens, and now it's bigger than most of the centralized borrow lend desks in crypto. And so that's the first part of why tokens are important. So bootstrapping.
You're saying people, because they're going to be compensated in the native token additionally through sort of a controlled, limited period of time inflation, that this incentivizes them to put capital up to be lent out at lower rates?
Right. And, at the current juncture, the token doesn't do anything other than it gives you governance rights over the protocol. And, this is kind of akin to, wishing for more wishes. You get this governance token. It controls the interest rate calculation. It controls the assets that are listed. It controls the general corporate strategy. It controls, the smart contracts themselves. And, all of this stuff is great, and the governance is amazing, and you can vote in, even cash flows that accrue to the protocol to be distributed to the token holders themselves. But, really the second point, which encapsulates all of that, is just this idea of community ownership and, distributing ownership and voting rights and, control to the network users is really something that isn't possible in, equity capitalized companies today. Like if you look at Twitter, it's a great product, definitely. Is it managed by the community? It's not. It's managed by Jack and his two buddies and Elliot, the activist. And that's cool. But really kind of what you're seeing with internet culture and the TikTok generation and memes in general is that community ownership is powerful. Memes are powerful. Making things go viral is powerful. And really, this is just kind of it's just corporate equity on steroids. It allows you to do things with protocols that you really can't do with equity companies, and allows you to kind of cut the life cycle of building traction and network effects by, order of magnitude. And that's the really powerful stuff about tokens, is just the community ownership.
Oh, I should also specify, these are all collateralized debt, right? These are collateralized loans across the board.
They are right now, but we're making investments into things. So for the people at home, if you put in $150 of ETH on Compound, you're able to borrow $100. So then your notional exposure is $250. But, very rapidly, things like credit scores and identity are being brought on chain. So when you go up to these protocols, they have a sense of who they are or who you are. And they can start to evaluate credit risk, and they can start to build bespoke insurance and credit risk models around, your particular personality. And so really what you're seeing is okay, DeFi is this really weird experiment. It's growing really quickly. Okay, it's eating, the centralized crypto exchanges like Coinbase and Binance, like, sure, that's definitely going to happen. But like the next stage of this is bringing on identity and people who are used to traditional banking experiences, which are just terrible, or if you're living in a developing country that don't have any banking experiences. And once you have that, you can really start to replicate a bank, an insurance company, a derivatives exchange on chain. And, in addition to being more transparent, it's community owned, the rules, you can impact the governance if you want, and you're earning tokens from anywhere in the world if you're just interacting with these. And that's a very powerful concept, especially today when everybody's locked inside.
Yeah, the more I listen to you talk, the more I think that when you talk about innovation, it sounds to me like what you're really talking about is retail and consumer innovation at the consumer and retail level.
Absolutely.
Right? Because a lot of the innovation we've seen in finance has happened B2B.
Exactly. And a lot of this is innovation in terms of what this consumer viable product category ends up becoming. But a lot of this innovation is just in the fact that, as Vance said, tokens are corporate equity on steroids, but it's also a completely open design space for any concept. And if there are open and fair and transparent controls, like an open governance process and one token, one vote, those are things that can be controlled by wishing for more wishes. And you get a chance to dictate the outcome, but also participate from a user level.
Yeah. Also what you said about as DeFi becomes, theoretically speaking, more integrated, that brings up oracles like Chainlink. And if you're pulling in data about consumer reputation score, credit scores, et cetera, that's where that becomes really important. And I do want to get into that because that's a huge part of, you guys are, I think, the biggest investors in Chainlink outside of kind of core founding team members. You can correct me if I'm wrong. I've repeated that before, but I can't remember if I got it wrong. Before we do that, though, give me one more use case or opportunity that you're most excited about. And let's say that you haven't already, but we haven't seen, like I know you're excited about Chainlink, but you guys have already invested heavily in it. Chainlink has been gaining a lot of traction and momentum, and Chainlink is going to get us into a conversation about memes, by the way, which I'm very excited to talk about because it's fun, but it's also actually really interesting and smart, and I think our audience will appreciate it. But give me one more use case that you guys are super excited about.
Synthetic assets are a huge product category that, deserve to be broken down into a bit more detail. But, just to give an example of one of the more powerful ones, stablecoins on Ethereum, there's almost $8 billion of them. And I think that's up from about $4 billion at the start of 2020. Really the fastest growing asset class on chain and one of the most interesting use cases. Specifically, synthetic US dollars are used in Asia for medium exchange, store of value in a country or a set of countries where you can't really get access to stable currency. So
when you say synthetic US dollars, are you talking specifically about SUSD on Synthetix platform?
SUSD, USDT, these are all being used at fairly large scale to settle transactions, within China, across borders in Asia, and amongst a lot of different other countries. Like in so many of these developing countries, you simply cannot get access to US dollars through the traditional financial system. Like it's just a non-starter. But if you're able to get money on chain, which, a lot of countries, still allow, like crypto fiat on-ramps are totally fine. And then once you're on chain, getting to USDT or SUSD is really just one more hop and you're into a stable currency. And this kind of depends on where you sit and how bullish you are on the US dollar. But, for a lot of people, that's their best bet. And so you have these use cases emerging of people really like buying and settling with these assets. And this is just going to dovetail. Like now you have synthetic Japanese yen, you have synthetic Korean won, you have synthetic, Australian dollars. There's so many different use cases that these things can be used for. The existing credit system, really when you use a credit card, what you have a claim to is the intermediary and their credit risk. When you use stablecoins, you're able to replicate a cash-like certainty of a transaction between two people without the volatility of something like Bitcoin. And so synthetic assets, finding real use cases among retail people who have no other reason to interact with crypto and are not in kind of this speculative audience of DeFi or punting Bitcoin around, that's one of the most encouraging use cases we're seeing because that's just real people using this stuff.
Okay, so maybe we should actually use this opportunity to dig deeper into Synthetix since we seem to keep going there. Why do you guys feel that we need a new derivatives marketplace? Why can't someone who wants to speculate in the Japanese yen do it to their satisfaction today in existing options markets? or futures markets?
Yeah, so they absolutely can. And to speak to Synthetix in particular, and then maybe derivatives exchanges writ large, Synthetix is more than just an exchange. It definitely has an exchange called Synthetix Exchange where users can transact in synths, which are synthetic assets that represent underlying assets themselves. They can transact in that exchange. But what really Synthetix provides is a set of price feeds for all these synthetic assets, which is powered by Chainlink, and a collateral pool with which to derive value. And after you have both of those two components, anything can be made into a synthetic asset so long as there's a reliable price feed and then collateral to use. And so that's what really gets us excited about Synthetix. It just becomes a new form of design space for DeFi. And what Vance said earlier about we see there being money Legos everywhere, and that's really kind of how we get excited about different concepts. Well, Synthetix kind of just becomes a Lego box in and of itself, where anything can be created out of it and be used elsewhere. One example of this is Curve, which is a stablecoin automated market maker where users can transact DAI for SUSD, for USDC, etc.
DAI is maker's stablecoin.
Exactly. But that SUSD, which is created out of the Synthetix ecosystem, out of the Synthetix platform, is then one of the largest collateral pools within the Curve ecosystem. So these assets don't stay endogenous to the Synthetix platform. They actually proliferate and become major components of other platforms elsewhere. And that's the composability aspect of it. So to answer the first question, Synthetix is just a ton more than just an exchange. Why there needs to be an exchange is it becomes, for these assets, it becomes the large value accrual method for paying or compensating those people that put collateral into that backstop for the synthetic assets. It's one of the most powerful reflexive models that we've seen in crypto, because as more synthetic assets are minted, the best and primary place to transact those assets is the Synthetix exchange itself. And exchanges, as we've seen with Binance, with Coinbase, with BitMEX, they're some of the best value accrual mechanisms in this space, and it's where you can actually derive real revenues. And having one of those for the assets that you're creating to compensate the people who are collateralizing those assets is just purely reflexive.
A dubious word in finance, reflexive.
Works both ways.
It can work both ways. So let's get into Synthetix because, this can get very complicated, but I actually want to see if we can sort it out for people. It is a very interesting model, I will say. And originally, Synthetix, as I understand it, was actually the stablecoin haven. And the team's founder and then the larger team, they kind of pivoted at a certain point. Was it like 2 years ago or a year ago they pivoted?
Yeah,
to create Synthetix?
It was about a year and a half ago. Yeah.
And a lot of these stablecoins seem to share some very kind of similar principles. And a lot of them sort of operate like a bank. And in some sense, the way I think of Synthetix, it feels a lot like a gambling pool. It's where everyone kind of throws their money in a pot and then they all get a share of the winnings over time with no kind of end in sight. You can kind of pull out anytime. How would you guys describe the Synthetix platform, the network, how it works, how the token economics work?
Yeah, so there's two things happening on Synthetix. The trading is what Michael described over the last question, and the staking is kind of the other side of the house, which backstops all those trades. So if you think of a bank, you go to a bank for a loan and they have a large pool of collateral and you assert your creditworthiness and they'll give you a dollar denominated loan. Synthetix is kind of a more aggressive version of a bank where they have a large collateral pool. So every dollar of debt they give out is backstopped by $7.50 of collateral on the other side. That's denominated in their SNX token.
Now, in their white paper, they had an 800% figure. Was that just like they changed that recently? They lowered the amount of collateral they needed?
So the collateralization ratio is actually a mechanism for rebalancing the synths in the marketplace. And so it's a fluctuating number and will probably be decreasing over time, but it's been up to 850, it's been 800, 700, 750. They can change it.
But as generally the system gets more stable, that collateralization ratio will drop. So back to kind of my point about the bank, instead of just giving out dollar-denominated loans, Synthetix is effectively giving out loans denominated in synthetic Bitcoin, synthetic ETH, synthetic Tezos, synthetic gold, synthetic Korean won, really anything that you want in terms of the synths that are listed on the platform, you can go up to Synthetix and either buy USD, SUSD, and then reprice it for that other debt, or you can just mint that debt when you stake your tokens. And so what you have is you have this basket of assets that the debt is denominated in, and a huge collateral pool to backstop it, because that debt fluctuates a lot more than just US dollar denominated debt. And so from that, you basically have this huge collateral pool that if you have SUSD, that SUSD is $1, but it's also the right to reprice it into any other debt that exists on the platform. So you can go with SUSD, send it into the Synthetix exchange contract, and you can get synthetic ETH back, or you can get synthetic Bitcoin back. So it's really this interesting thing that's, it's debt, but it's also a right to reprice it. And this repricing is really kind of the exchange side of the equation, where you're able to trade debt and speculate on options or futures or whatever financial instruments are listed on the platform, but it's all denominated in SUSD. The other part about the collateralization ratio is that, say people could mint as much synthetic debt as they would want just with $1 Synthetix. What would happen would be when you would take that SUSD and you would try to sell it for USDC or USDT, that selling pressure would eventually cause the peg to deviate. And so controlling the supply of the synths in the market is largely a factor of the collateralization ratio. If it's super high, there's not going to be that many synths, and so the peg will rise. It may even go over $1. But if there's too many, it'll go under the peg and it'll trade at like 95 cents SUSD to USDC. And so it's really kind of, it hits on our philosophy of like, yeah, sure, we buy tokens and that's all nice and good, but we are really managing these things like a central bank. We are extremely activists. We have proprietary technology, dashboards, and a team of 6 engineers that are literally working around the clock to keep the system healthy in the face of, massive price increases, lots of synthetic debt in the system, huge amounts of trading activity. It really does take a village to kind of pull off the management of one of these platforms.
So you guys are running what is effectively a stable coin against every other derivative asset, every other derivative in the pool, right?
I think I get this. Yes, we are. We're effectively managing the peg of all the synthetic assets alongside the core team, alongside other core contributors, and we're just generally kind of stewards of the protocol's health.
So the threat against the solvency of the pool, which provides this kind of frictionless liquidity, since you don't actually need individual counterparties, everybody is a counterparty to the pool itself, to the debt pool that is SNX collateral, right?
So to be clear, everyone who is staking is a counterparty to the debt pool, to everyone who is trading. And that dichotomy is sort of a fine nuance, but it's really important in that you can absolutely be a user of the platform just by going onto an exchange and trading your dollars for synthetic US dollars, and then trade synthetic US dollars for synthetic ETH or any of the other binary options or futures products. But as a staker...
On a third-party exchange, on a separate exchange, not on the SNX platform.
Not on the SNX platform. You're just interacting with the synthetic assets. But if you're a staker, you are both staking your SNX to get SUSD, participating in the collateral pool as a counterparty, and you're receiving fees and compensation for doing so, but then you're also having to manage your SUSD as a trader. So one is inclusive of the other.
So I have a question. This is interesting. I hadn't realized that. So there can be a whole sort of spectrum to which the people actively trading these derivative products, these synthetics, can also be actually staking at the same time, correct?
Absolutely. We're a staker and we're a trader.
It seems like the most stable, safest environment is one where everyone who's trading is also staking, which is actually why I had thought about it as a gambling pool where we all throw in and then we just kind of trade pieces of paper the entire time. And when some person gets up, some person gets down. If you've got the opposite scenario where you've got, let's say, $100 billion or $100 million of money is being staked by individuals, and you've got a bunch of, let's say, third-party traders who aren't actually staking, what's the likelihood that some, significant number of those people staking get spooked and they withdraw, they pull out? And then that sort of dries up your liquidity.
And this goes back to your point on reflexivity. And so it works in both ways, but this is where the proliferation of synthetic assets is a crucial strategic imperative for Synthetix, the platform, and the ecosystem. And having a diversity of participants on the staking side as well as the trading side, but most importantly on the integration side. So Curve is one example of a place where SUSD is used. Aave, as we mentioned earlier, is another example of where SUSD and SBTC are used as collateral options. So the more use cases you have, the more stability you have in getting access to these assets. But at this point, the collateral pool and the staker ecosystem is so large and so diverse that it's hard to assume that there would be one or two large players that would be able to change the market. And I think the other aspect here is that when you are a staker, you're receiving inflationary rewards, as you described, but you're also receiving a cut of the fees that are generated by the exchange. And as we see this excitement in DeFi and the proliferation of these assets, there's more fees that are being generated, and that cash flow is pretty attractive. So that is a reason in and of itself to want to be and stay a staker.
Yeah, although there is a ton of volatility in this space, even more than traditional foreign exchange markets, and we've seen currencies come under attack and pegs break in those places. So I mean, it's not something to sneer at. Not that you were sneering.
No, definitely not sneering.
Yeah. And also another way I could envision there being issues is, again, although this would be, I guess, less traumatic, would be if there was a sort of a major move or a major unexpected move in a synthetic asset in the pool. Yeah, this all kind of just gets to the larger observation, which is that these are extremely complex markets. And as you add more synthetic products, you logarithmically expand the complexity. And so, like, I wonder, and I'm almost afraid to ask this question because I don't even know where it would lead, and I don't want to get caught in the weeds. But I do wonder, how does your software, maybe high level, manage kind of liquidity needs in the face of such fluctuations?
Yeah, great question. And we agree about the complexity and logarithmic scale. It is definitely not for the faint of heart. I would say one of the reasons why we describe ourselves as a DeFi fund is that it is dangerous to be investing in the space without living in the space. And it's really all that we do. And that's why we have Framework Labs as an entity to really test this stuff and try this stuff to the point where it's battle hardened and we feel good about it before making a large investment. And our software leverages a number of other platforms like Aave and like Curve, as I described. And the advent of Curve in and of itself and the addition of synthetic assets to Aave present a new opportunity to manage that liquidity programmatically. And the software itself is definitely extremely complex and definitely very interesting, but we're leveraging a lot of other platforms that exist where there's collateral, there's a peg, there's traders, there's users. And Curve, I think, is a great example of this, where you've got hundreds of millions of dollars of depth of stablecoins and a new swap mechanism that allows for millions of dollars of trading volume in single transactions without moving that peg very much. And we've done it, we've tried. And it's really interesting to see the advent of those because that benefits us and it benefits the Synthetix ecosystem, and we get to leverage them through our software.
So you guys are managing your internal, well, you guys, sorry. I mean, this is so easy to conflating the Synthetix team with you guys who are investors in it. But they have an internal ledger that they're keeping account at all times of who owns what or what percentage of what. Like, how does the team secure the debt register from being altered, for example? Like, that seems like also like a very simple but a very important problem.
It's a huge problem, and the solving of that is what enables Synthetix in and of itself. It is all kept on chain. It's all managed through tens of different smart contracts that are interacting with each other to build the network and build the ecosystem. It's all written and open and transparent for anyone who would like to view it. You can see the different transactions that are being processed through it in real time. And now the team has announced and is transitioning from a team-based model where the core team has the admin keys for the control or upgrading or changing of those contracts. It's moving to a DAO-based model where there are multiple parties that need to literally sign, cryptographically sign a transaction to upgrade these contracts, to change them in any way. And doing this all with users that are actively looking at the network, actively looking at the code is really what DeFi is all about. And it's the ability to see that happen in real time for anyone, anywhere in the world. That adds to the level of trust and transparency. And you can do very, very complex things like manage an entire debt ledger on chain.
That's really interesting. So like, you guys, how long after a transaction is completed on a platform like Synthetix is it actually written to Ethereum's base layer?
It all happens in real time. So there's a website called etherscan.io, and it's the predominant place to go and view different transactions. It looks like a Facebook page almost, and you get to see different wallet addresses. You get to see different smart contracts that people are interacting with those wallet addresses. And you get to see everything happen as it happens on the Ethereum blockchain. And so from message signature to proliferation to the peer-to-peer network to actually viewing it on Etherscan, it is seconds.
That's really interesting. So you guys are really dependent on Ethereum being able to meet its roadmap goals and to continue to be able to scale.
Yeah. So, if you look at Ethereum today, an average transaction might cost you $1, $2. If it's super complex, $10. This is a network where demand for services exceeded supply of computational power. And so, to your point, we really do rely on Ethereum to scale itself, but we also rely on a number of third-party scaling solutions that are really going to start coming into, production level usage in the next 6 to 9 months. But, you're totally right. We need to get to Visa, Facebook level speeds, 10 to 100,000 transactions per second. And that'll come in time. Ethereum really, it had this huge coming of age moment in 2017. And then it wasn't really clear what the leadership was, what the plan was, who's going to do what. About a year and a half, probably 2 years ago, they had a meeting and they were like, listen, guys, like we got to figure this shit out, like, or else, this just isn't going to work. And so they've kind of set up on this ambitious roadmap of ETH 2.0, which is effectively breaking the blockchain into different shards. So, you might have a DeFi shard, you might have a, stablecoin shard, you might have any number of context specific shards where the amount of data you're processing and putting on the base chain is a subset of kind of what's happening in that shard. And so that was a probably long-winded explanation of saying...
No, sure. Also very complex, though. And
it's so complex.
Yeah. I mean, I'm not a person who's qualified to assess its difficulty, but just, as an amateur, it seems very, very, very difficult. And I think it's also partly why they've not just sharding, but a number of their different proposed solutions, including POS. I think it's partly why they really haven't made a lot of progress in the last few years.
It's super complex. And I think there's an aspect of, when you log on Instagram or Facebook, you don't know what, database architecture they're using. You just notice if it's, slower or faster than usual on that day. And at this point in the UX of ETH, you're sitting there and you click hit send, and then you probably have to wait a little bit to kind of see your transaction on chain. And that is, when you're participating in these DeFi protocols, when you're arbitraging stablecoin pegs, when you're moving really quickly in real time around futures or options exchanges, that type of latency is just not something you can really deal with.
Well, didn't they have something happen in like around March where the network clogged again?
Yeah, I mean, so that I think you're referring to, I think it was Black Tuesday or there's some colloquial term in the crypto community, but prices dumped on a centralized exchange, and effectively what you see between all these centralized exchanges is that Ethereum is basically the highway between these two cities. If you want to send stablecoins from one exchange to another, you're sending them on Ethereum. And if the highways are closed, the two cities can kind of get dislodged pretty quickly. So you saw BitMEX, which is a large Hong Kong-based futures exchange, their price totally deviated from the rest of the market. And, that is the example of like everything that can go wrong did go wrong. And, as Ethereum starts to scale, less and less of those things will happen. I will say that, at low dollar amounts, figuring out these complexities and these hiccups, it's good to do it now rather than when we have, hundreds of millions, if not billions of people on these platforms and their money is living there in real time.
Yeah. So listen, guys, I'm going to move the second half of this conversation to the overtime. I want to, as I mentioned, I do want to discuss Chainlink, obviously, because that's been, I think, your most successful investment by far. And it's there's just a tremendous amount of community support for the project, and that'll get us into a conversation about memes. I also want to try and talk about token economics or cryptoeconomics, because this is something that I covered on the show a few years ago with some other crypto fund managers at the time, and this is something you guys hinted at the beginning, which is that the thesis of fund managers at that time was very different than it is today. Similarly, the models that people used to try and value these software ecosystems were very different. And that's been kind of one of the interesting, exciting, fun things about the space, which is trying to understand, like, how do I put a value on this thing? What is this? How do I evaluate it? It's so difficult. So that's kind of what I'm thinking, and then whatever else we can get to. For regular listeners, you know the drill. If you're new to the program, Hidden Forces is listener supported. We don't accept advertisers or commercial sponsors. The entire show is funded from top to bottom by listeners like you. If you want access to our premium content, which includes transcripts to every conversation we've ever had on the program, copies of my rundown, which this week is something like almost 30 pages of research that I put into to prepare for today's conversation, or if you just can't get enough of the podcast and you want to hear more from my guests, head over to patreon.com/Hidden Forces and subscribe. Not only is the content worth it, but it's a great way to show your support for the show and the work we do. Guys, stick around. We're going to move the second part of our conversation into the overtime. Today's episode of Hidden Forces was recorded in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription, available through the Hidden Forces website or through our Patreon page at patreon.com/Hidden Forces. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.